All right. Good evening, everyone. I think it's time to get this going. Tonight's presentation, How to Invest in the Stock Market Profitably. My name is Tyler Ballhorn, founder of Stockscores.com. I've been a trader for 30 years, a teacher for 20 years, and tonight I'm going to take you through my approach to investing in the market. Longer term trading, by no means long-term investing, long-term trading, where we typically would hold for a few months. Basically, as long as the stock is moving up and beating the market, we're interested in it. But once it calms down and becomes sort of a normal stock again, then we move on to something else. And that's what I'll talk about tonight. So the itinerary, I'll begin with a little talk about how I got started in trading and the theory behind my approach, what I focus on, how long does it take to apply my approach. I'll give you a tour of the Stockscores Education Center. And then the last thing that we'll do is we'll do a market scan in search of opportunities. So we have a tool on the Stockscores website that allows us to search through the entire North American stock market, Canadian and US markets, and identify stocks that meet the requirements of a number of different strategies. And we'll do one of those scans tonight. So let's begin with how I got started in trading. I was about 31 years ago. I set out to, basically I was going into business school and I thought I should know something about the stock market. So I played a stock market game and enjoyed it and kind of got hooked on it. I had friends, we all sort of played the penny stocks because we were all starving students, didn't have a lot of money. I started with about $3,000 of capital that I had saved up from where I worked, and I think my grandparents gave me some money or something. This is a long time ago, of course. And that's basically how I started. I did it all through university, kind of paid my way through university. And in the early years, I traded off of stock tips, largely. Things that I was learning in business school, which was doing fundamental analysis. And after a year or two of that, I realized that it didn't really work very well, at least not for me. And so I set out to reverse engineer the stock market. I was sort of an early hacker of the stock market. I thought, well, maybe what I should do is look at all of the stocks that have done really well in the last month, 3 months, 6 months, and see if there was any consistent patterns or clues early in their period of outperformance. And I can recall going to the business library at the university that I went to, and we had these books that had charts of all the stocks listed on these on markets. And I would just go through and pull out all the ones that had done really well and just look at them a long time and study them. I at one point, I started to get an interest in stock charting. But this was before you could, go to a website and look at a chart. I actually started out by writing out charts by hand, if you can believe it. I had a year's worth of financial newspapers, and I would take stocks that I knew had done well, and I would, on graph paper, write out their charts by hand. That's a long time ago, and of course, thank goodness we don't have to do that anymore. But in that pursuit of reverse engineering the stock market, I went back to something I had learned in my last year of university. I was studying a class on mergers and acquisitions and whether there was evidence of insider trading in the shares of these companies that were bought by another company. I talked about this a little on Saturday. I won't go into it in much detail again, but essentially what we found is that there was consistent evidence that there were some people trading on inside information in the market. And what was important about that study that I did in university was the math that I learned from that class. I learned some statistical analysis techniques that I then eventually applied to developing my own system or model or indicators, well, all of the above really, that I still use today. It's the basic concept of what I do today is the same as what I was doing 25 years ago. It's way more sophisticated now, faster, computerized, all that kind of thing. But it's largely based on the same concept, and that is the stock market isn't fair. People that have better information than I do have an advantage. And fortunately, when they act in the market, they leave a trail to be followed And the easiest way to follow it is with computer algorithms. Now, when I figured all this out, maybe 7 or 8 years into my trading career, I started designing a website and an online tool to essentially scratch my own itch. I was spending too much time trying to find these abnormal stocks that I'll talk about tonight. I was spending too much time manually running my algorithm through Excel spreadsheets and in sort of early technical analysis chart programs. And so I went out and built my own tool, partnered up with a company called Stock Group, and I gave them the math and the strategies, and they had the programmers to build it. And we spent probably $250,000, $300,000 developing this tool. Now that tool's been rebuilt a few times since then. That was 20 years ago, 21 years ago. But again, conceptually, it's the same. And so we're always working to improve it and make it more efficient, faster, that sort of thing. But I built my own tool because there wasn't one out there, and there really still today isn't an online tool that I could use to do what I do. And so what I'm going to show you tonight isn't doing something that everyone else is doing. It's I always remember my grandfather telling me, if you always do what's always been done, you will always get what has always been got. Maybe not the best English, but if you want to be average, do what everyone else is doing. If you want to beat average, you have to do things that most people don't do. And so that's kind of the idea behind Stockscores. It's doing things that most people don't do. You won't see a lot of marketing for Stockscores. I don't actually want it to be a huge website with tens of thousands of people using it. I like that it's relatively small in a little niche, because ultimately the tools that I built, which I'll show you tonight, were built for me first. And they're expensive. I spend like $100,000 a year to keep that website up and running, and that's an expensive tool. So I like to share it with the people that I teach each year. I don't teach a lot of people. I'll talk about that later as well. But 30 years of trading, 20 years of teaching has taught me that if too many people are doing what you're doing, the opportunity goes away. And so I like to keep the audience small, and primarily it's people in Western Canada, although we do have users all over the world, but it's not easy for those people outside of Western Canada to find us because they just don't do a lot of marketing. So if you're here from outside of Western Canada, welcome. I'm glad that you found us, but don't tell too many. All right, let's talk a little bit about my theory behind the Stockscores approach. My aim is to find market-beating stocks. Again, I'm not satisfied with being average. If I was satisfied with being average, really what you should do, or what I should do, is invest in a low-fee index fund. Because if you just bought the S&P 500 and held it for 20 years, you do quite well. It's consistently profitable year after year after year. Has some volatility along the way, but as long as you have a low fee, you can earn average. And there are low fee ETFs out there and that sort of thing. But I don't want to be average. I don't think any of you here want to be average. Average is 8% a year. I want to make better than average. In order to do that, I have to find market-beating stocks, which are what we call alpha stocks. Alpha stocks are those trading or moving faster than the market. They have something going on within their fundamentals, within their story, that makes them move faster than the market. So, for example, in the last, say 2 or 3 weeks, one of the hot sectors has been crypto ETFs, stocks that are somehow related to cryptocurrency, whether they're crypto miners or like websites or tools that allow people to buy and sell crypto. So that's been a hot sector, and those stocks have done really well. Over the last year, the hot sector has been energy. Energy was one of the worst performing sectors for the previous few years. But this year, 2021, I think it's been the top performing sector. I think the number 2 sector has been shipping. And then there's also just individual stocks that have alpha. A biotech stock that finds a cure or a treatment or a new drug for some disease will go up very sharply regardless of what the stock market is doing. And we've seen, biotech stocks go from $1 to $5 because they found that new drug, something approved by the FDA or something like that. So that's alpha. All right. So you have alpha sectors and you have alpha stocks. And if you're going to beat the market, you can't diversify. You have to focus in on the sectors and the stocks that are beating the market. And my method that I'm going to show you tonight does that, or sets out to do that. We'll talk a little bit about how and why it does that. But here's an example of a stock that I bought right back here. And it is a stock that has outperformed the market. It has gone from, at the point when I picked it, around 725, and today it's over 12, pushing $13 right now, 12 and a half. It almost hit 13 today, and it pulled back to below 12. But on a percentage basis, obviously that is beating the market, and that's what we want to do. So the question then is, how do we find these stocks? Why do stocks move in these strong trends? What is it about them that causes them to do that? Well, it really comes down to stocks attracting the crowd. In the last year and a half, since COVID crashed the market in February of last year, once the crash was over, and it was very quick, it only lasted 6 weeks or something, actually not even that, we had a very, very strong market rally. And what happened is it really attracted a lot of people back to the stock market. For the previous 5 to 7 years, many stock speculators left the stock market. They maybe moved into real estate or cryptocurrencies, but I think largely it was because baby boomers, who had been the speculators in the market for the first part of my career as a trader, the first 20 years, let's say, they no longer wanted to speculate on stocks. They were now interested in preserving their capital. And so instead of buying those smaller companies and trying to push them higher, and as the crowd gathered around those stocks, they just started buying exchange traded funds. And then you had large hedge funds implement algorithmic strategies with the aim of, beating the market little pieces at a time. And so that's really what the market was up until COVID. It was not very volatile. There wasn't a lot of hot stocks. There were some. I mean, every week there were some, but certainly not like it has been for the last year and a half. So anyway, COVID hits. You get a resurgence in retail traders. Millions of new brokerage accounts were opened globally by retail traders. People putting in $2,000, $5,000, $10,000 into the stock market and trading a relatively small group of stocks. And these small group of stocks were trading hundreds of thousands of times a day. And they still are. Today, there was a number of stocks that traded 200, 300,000 times. And prior to COVID, it was rare that a stock traded that actively. So you've had a real dynamic change in how the market operates. It reminds me of, the tech bubble in 1999 and 2000, because there's lots of hot stocks, but this is a little bit different. There's actually a fewer number of hot stocks, but a much bigger crowd chasing them. So why do stocks move in strong trends? Well, ultimately it comes down to the perception that there is good fundamental value there. I mean, people always have to talk the story. And the story has to sound exciting. It has to attract people. Now, we've had some ridiculous stories in the last year and a half. We've had, the meme stocks like GameStop, which have gone up simply because a large group of people in a chat room on Reddit decided that they wanted to do a short squeeze. That's kind of unheard of. It's not totally unheard of. We've seen that before, but not on the scale that we saw it. And we had these meme stocks, the Reddit stocks, the Wall Street Bets stocks that some of you may have heard about, GameStop, AMC, BlackBerry. There's a list of 10 or 12 of them. And that's where the crowd gathered. Now that group has kind of quieted down, although BlackBerry had a really good day today. But But there's always now this very large crowd of retail traders piling into these stocks. And sometimes fundamentals have very little to do with it. It's just they get hot. And so really, when we talk about why stocks move in strong trends, if I was in business school 30 years ago, I would have said it's because the fundamental value has changed and people are assuming that the present value of future earnings expectations has improved, blah, blah, blah. That doesn't matter in the stock market. What matters in the stock market is there's more buyers and sellers. It's kind of supply and demand. And in theory, it's not supposed to work that way. What you learn in business school is not that. But in reality, we see stocks every day that go straight up and then 2 days later, they go straight down again. Or sometimes it's 6 months straight up and then 6 months later, straight down again. And it's this sort of, it's almost like stocks go viral. The mood is caught and people pile into it. And maybe there's a good story. Maybe it's a bunch of baloney. Doesn't matter. These stocks still make these big gains when crowds move in on them. And so we can see that these stocks do this. And sometimes it's $2 stocks. The one that I'm showing you here is a $380 stock. But you can see that what happened was this stock has made considerable gains from here to here just in the course of 2 or 3 months. But it always, I shouldn't say always, 95% of the time, it starts the same way. You have a stock that nobody cares about, that's quiet, and then it comes alive with abnormal activity. The crowd gathers, the crowd pushes it up. Now let me ask you, do you want to be a buyer up here or do you want to be a buyer here? Well, some of you might say, well, I want to be a buyer right here. Number 1, number 2, or number 3. What's your answer? Well, I would expect that very few of you are going to say 3 because that's too late. Some of you will say 1, and that makes some sense, but in a moment I'll tell you why that's actually a bad idea. And really, number 2 is the right answer. Now, let me start with why 1 is the wrong answer. The problem is there are lots of stocks that are trading quietly and boring. And there's no predictive value to buying here because there's no sign that there's a crowd gathering. There's no excitement yet. The stock is boring, it's quiet. So yes, you can buy at 0.1, but many times those stocks will go sideways for many months and you're tying up your capital in something that isn't moving. Whereas if you buy at point number 2, when the stock first starts to show abnormal behavior, yeah, you're paying a little more than you would have if you had bought it a week before. However, your probability of success went up a lot and you're not going to wait as long. So your capital is more actively used. So that's why you want to be a buyer when these stocks break from low volatility with abnormal activity. Now stick around until the end of tonight's presentation because I will show you the tool that I use to find these things. It's called the Market Scan. I built my first version of the Market Scan 20 years ago. It's had a few updates since then. We have real-time version of that for day trading, which I'll talk about in tomorrow's webinar. Tonight, we're going to talk about the longer-term version, which we use for what's called position trading, which is what we're talking about tonight. So stocks move in strong trends because they gather the crowd. Now, my next point, and I said this on Saturday, is that the stock market is not fair. There's always some people that know more than the rest of us. Now, they may know lies, they may know truths, they may know inside information, they may have the resources to do really good research, but there's always some people within every company that just know more, and therefore they are better at predicting where that stock will go. And in that way, the stock market isn't fair because we don't all trade on the same information. But that's okay because those privileged people, smart people, well-informed, whatever you want to call them, lucky, they leave a trail for us to follow. When they start buying a stock aggressively because they have better information, they will leave little crumbs for us to pick up and follow that trail. And the crumbs come in the form of abnormal activity. So I don't know if any of you follow commodity prices, but 6 months ago, lumber prices were ridiculous. Like a sheet of plywood went from $20 to $60. Lumber prices went crazy, and then all of a sudden they collapsed and they went back to normal. Well, another commodity that's been very hot is aluminum. And I've noticed in the last month or so quite a few headlines about aluminum prices being quite high. And so if I was listening to those headlines, I would have been looking at aluminum stocks in here because that's the first time that I heard about it. Now, admittedly, I don't really listen to the news much. I don't read newspapers or watch financial television, and I'll explain why in a moment. But that's when I started hearing about it. So if I was buying stocks based on what I heard in the news, I'd be buying Alcoa here. But the reality is Alcoa broke its downward trend line and started to build optimism and give buy signals right about in here in November of last year. So almost a year ago, this stock was giving buy signals using my methodology. So when I talk about the stock market not being fair, well, this is the group that follows that industry the closest. Maybe they knew that aluminum prices were set to climb. Maybe they knew that earnings were going to improve. I have no idea. I really don't care. All I know is that the market was telling us that there was something happening. And this is a weekly chart, so the abnormal volume doesn't necessarily show up as well. When we look at a daily chart from that time zone, you would see some of that abnormal behavior a little more clearly. What I wanted to show is that this stock went from being ignored to being liked, and it shifted from falling tops, which is a sign of pessimism, to rising bottoms, which is a sign of optimism. And you should also notice that my Stockscores indicators went from being below 60, okay, this is about 60 here, to being above 60 as that stock went into its upward trend. So we have these indicators that help us find those. Now, again, this is a weekly chart. You might buy here, sell here 3 weeks later, buy here, sell there 2 months later. You can trade in and out of these things. And again, I'll show you some of that stuff tonight. But the point here is that the people that know the most about this industry were buying, back in this zone, and the public's learning about hot aluminum prices in the mainstream media much later. Now, the next thing that we have to understand, and that I learned a long time ago, probably the hard way, is that we should not expect to be right all of the time. And that means that we have to have a methodology to know when we are wrong. Because to be a successful investor in the stock market requires to have small losses and bigger profits. So let's first talk about how to take small losses. So this is a stock that I bought right here. It met the requirements of a strategy I have called a bottom fishing strategy. And just to give you the quick version of what that strategy does, it looks for a break of a downward trend line, step 1, build of a rising bottom, step 2, and then a break from a rising bottom, step 3. And it's a great way to find stocks that have been, really beat up and are likely to reverse. And it worked so well in February, March of 2020 when the COVID crash started to turn higher. And I was picking 5-6 stocks a day that were doing this pattern. And they went on to, many of them, 100, 200% gains. But in this case, it didn't work. But the question is, when do you take the loss? So your first lesson tonight is to never set stop losses based on percentages. Some will say, well, I'll sell my stock when it goes down 1% or 5% or 12%. They just pick a number out of thin air. And that makes no sense because the loss that you take should be based upon the opinion of the market. When I buy this stock right here, I'm buying it because it's breaking from this low volatility here. The stock is trading quietly in a narrow range. And essentially, prior to this jump in the stock that day, everyone agreed that this stock was worth about $3.25. There was some rumor or some information that caused some people to buy that stock aggressively early in June. Very strong volume, very strong price. And if that information is right, then as more people learn about that information, we expect that stock to move into an upward trend. And that happens usually about 70% of the time. However, about 30% of the time, maybe 35% of the time, these people are wrong. They have some bad information, or maybe they're speculating on some, information that's going to come out, and then that information never comes out. And I'm thinking more about like if you have a pharmaceutical company, they're waiting for the results on their testing to see whether their drug is approved. Well, people will speculate on that before the news is out. The news comes out, maybe they don't get approval and their stock drops. In this case, I have no idea what this company does, don't care. What I know though is that my floor is right here, because that was the floor before the abnormal price break. And if that floor is violated, like it was about a month later, time to get out. I was wrong, no problem. I expect to be wrong some of the time. But in doing so, I take a small manageable loss. Now, if we go to our next side of the equation, when we are right, we have to let the stock work. So here is another example of a stock that I bought. I think it was on this day. And the reason was abnormal price action, strong volume, a predictive pattern. This is something called an ascending triangle. When I buy that stock, I'm going to put that stop loss just below the floor. And that becomes my risk. So if my entry price here is about, I'm going to round off, $3.75, and my support price is $2.75, then I know my risk is equal to $1 per share. And again, I'm just rounding off for simplicity. All right, so if I'm willing to lose $100 in any trade, how many shares do I buy? 100 shares. My risk is $1 per share. If I buy 100 shares, my risk is $100. If it falls and goes down below $2.75, I lose $100 plus maybe a little bit more for commissions and that sort of thing. Now, as it happened, the stock did not go down. It went up nicely and it was winning. And as long as it's moving in the right direction, as long as it has those rising bottoms on the chart, I got to stick with that trade. One of the mistakes that so many traders and investors make is they sell their winners too early. They sell their winners too early because it feels good to lock in the profit. Or more commonly, there is a fear that their profit will turn into a loss. How many of you have ever sold a stock because you didn't want that winner to turn into a loser because you've had some losers and they hurt? So human beings avoid pain and we pursue pleasure. And that's one of the reasons why we sell our winners too early. We're avoiding the pain of a loss and we're pursuing the good feeling of locking in a profit. Now, the right time to sell this stock was when the upward trend line was broken right here at a price of $5.25 roughly. So in that case, we made $1.50 per share on a trade where we were risking $1 per share. That means we earned a risk reward ratio of 2 or 1.5, sorry. 1.5 RR. You'll often hear me in some of my videos talk about reward for risk. This trade earned 1.5 times its risk. It's not a tremendous winner. I mean, we try to get things over 5, but still it's not terrible by any means. All right. So we want to limit the size of our losses and we want to maximize the size of our profits and let the profits run as long as that stock is trending higher. So when it comes to picking stocks, what do I focus on? We're going to do market scans at the end of the video or at the end of the webinar tonight, and I will show you how I do this. But let's just get the theory out of the way now. We want to focus on abnormal trading activity. All of those stocks that I showed you, which had been moving up from left to right, they started their upward trends with abnormal trading activity. Almost all market-beating stocks start their upward trends with abnormal activity. I'm going to say that again because it's very important. Almost all stocks that beat the market start their upward trends with abnormal activity. If you don't believe me, just go look at all the stocks that you know that have done really well, and you will see abnormal price movement, abnormal volume early in the trend. So great, buy everything that has abnormal activity, right? Wrong. Because the problem is not all abnormal activity leads to market-beating trends. In fact, most of it doesn't. So it's a bit of a conundrum. We know that almost all market-beating stocks start with abnormal activity, but we also know that most abnormal activity doesn't lead to market-beating trends. So we have to qualify it. We have to use predictive chart patterns. So when someone takes my one of my courses, whether it's my active trader course or my investor course, we spend a lot of time focused on how to read chart patterns. There are 6 elements that you have to understand in order to read a chart pattern. And early in November, I will be teaching my students this, but the list very quickly is support, resistance, optimism, pessimism, price volatility, and abnormal activity. And we take those 6 things, which are pretty simple, and we combine them to understand predictive chart patterns. And I'll show you in an example how some of those things can come together. All right, so let's say those 2 things check off. We've got abnormal activity, we've got a predictive chart pattern. The next thing we have to have is good risk management. We have to know when to take that loss, and we also have to know how to assess what the reward potential is for the risk that you take. So sometimes a stock will have a great chart with a great breakout from a predictive pattern, but the reward potential isn't strong enough for the risk you have to take, and therefore it's actually not a good trade to take. And oftentimes, I run a service every day for my active trader students where I am assessing stocks in real time as the trades come up for the opening half an hour of the day when it's busiest. And a lot of the time we just don't take the trade because the reward for risk doesn't make sense, even if it has a good pattern. Now, once you're in a stock and it's working, you have to be patient with that winner. That doesn't mean you hold it forever. It doesn't mean that you blindly hold it, but it means that as long as there is not a sell signal, and I teach you what sell signals are in my courses, as long as there isn't a sell signal, you just stick with it. And so on a stock like BlackBerry today, for example, it gave a buy signal for a day trade at 1 o'clock, and it never really gave a sell signal until the end of the day, when as a day trade, we might close that trade out. As a swing trade where we would hold for a few days, it's actually still a valid hold. So we want to hold our winners until there's a sell signal. We don't want to sell because of fear or greed or emotional reasons. We want to sell because our methodology tells us that now is the time to sell. Now, the last point there is I've written, don't try to get in at the low or out at the high. That is a fast way to become poor. Because if you're trying to get in at the low, you're trying to buy stocks that are weak, and weak stocks usually get weaker. Trying to get out at the high, that means you're always waiting for the stock to keep running, and when the market gives you a sell signal and it's not at the high, then you end up holding a loser, or you, more often than not, you just get out of the trade too early. So as traders, what we're really trying to do is get like 80% of the upward trend. So we're going to miss the first part and we're going to miss the last part. We're trying to get the big middle. And don't try to sell at the highs or buy at the lows, because it doesn't work and it'll end up making you a bad trader. All right, so let's look at an example here of a stock that sort of met the rules in the last little while. We have the abnormal activity right there, abnormal price movement, and you can see the volume stands out. Now, the scale is skewed by the volume that happened a few days ago, but up until that point, this was one of the highest volume days going back many months. Now, more importantly, it's also giving us the predictive chart pattern. So I talked about 6 elements of chart patterns, so we'll go through some of them here. So we have these things called inflection points, and that's a big part of what I teach in the first part of the course, which is called the foundation, where we talk theory. And what we're looking for are rising bottoms. So we've got rising bottoms on this chart. You can see how those bottoms are rising, and I can draw a line across those to define the rising bottoms. That is a sign of optimism. Now we also have a flat top here, and that flat top is called resistance. That's one of the 6 elements that we look for. And that resistance represents the upper boundary of what people are willing to pay for the fundamentals of the business up until that point. And so it stands to reason then that if you get a breakout through that resistance level, it must be because some traders have new information that justifies a higher price. So those are the people that know the most, and they're the ones buying right there when that stock makes the breakout. And they do so with some enthusiasm because the volume is also higher. So we've got all the things that we're looking for. We've got a break from optimism. Oh, and the last thing is we have low volatility here. See how the stock is trading in a very narrow range? These lines are converging toward one another. So we've got low volatility, we've got optimism, and we've got abnormal activity breaking through resistance. So we've got 4 of the 6 things that are important to understand when you apply my approach. And I spend a few hours in the course material teaching all of those things and how they all work together. I'm giving you the quick version tonight. All right, so we buy the stock here. We're going to plan to lose if it goes below that floor there. That is our risk. And currently, the stock is way up here. And it looks to me like this company has been bought because there's a big price gap here and then very low volatility. Now, I haven't read the news on this, but my guess is some other company has bought this stock. And if so, it confirms the idea that the stock market isn't fair because there were people buying back here. Maybe they knew that this was coming. I don't know for sure. Some people buying back here are people like me who are just buying the fact that there is abnormal activity from a predictive pattern. Now, it may sound all very easy at this point. I don't want anyone to think that it's easy. It's simple. It takes good tools. It takes practice. It takes knowing how these patterns work. And, it's not, I don't want anyone to think that in a 1-hour presentation, you're going to know everything that there is to know. So I've taught you enough to be dangerous at this point, but make sure that you take time to learn how to trade before you really start applying some of these things. So if you want to do this kind of approach to investing in the market, question is often asked, how much time does it take? Well, I teach for investors, I teach 6 strategies, and you see them listed there. The first 4 are strategies that you would do on a daily basis. You don't have to do it every day, but if you're going to do it, you do it typically in the last half an hour of the trading day or in the evenings. So if you work a job, you come home from work, you do your research in the evenings. If you're able to look at the market, in the final hour of the day, then you can do it then. And it takes about 15 minutes. Now, when you first start doing it, it's not going to take 15 minutes because you're learning. It's going to take you longer. I can do this process in like 5 minutes, but I've practiced it for 30 years. For most people, after a month or 2, they can do this process in 15 minutes a day. Now, some people don't want to be that active. They want to buy 10 stocks a year. And so they're going to take a longer term trading approach. And that's where we have a couple of different strategies, these 2 here, which are really variations of this. But instead of looking at the daily interval, you're looking at the weekly interval. And that takes 15 minutes a week. Okay, doesn't take a long time. And again, when you learn, it'll take a little more time. But once you're good at this, it's pretty fast. And it's because the tool really helps you to do that. And I'm going to show you the tool tonight. So the tool we use is something called the Stockscores Market Scan. Now, this is the tool that I built the first edition of it 20 years ago now, actually a little over 21 years ago now. Hundreds of thousands of dollars and many months of programming went into it. So it's not a casual thing, but it's pretty simple to use. We've got preset market scans that you just pull the scan up and it does all the work for you, or you can build your own scan if you're that type of person who likes to combine and do indicators on your own, that sort of thing. And I will show you this at the end of the presentation, how we do it. We'll actually run some market scans that are suitable for finding those longer term position trades. See if we can find something tonight. Now, it's doing some common things that you might see elsewhere. You can, scan for moving averages and some indicators, that sort of thing, things like MACD, which are common indicators. But what sets it apart is it's using my algorithms, my proprietary indicators, things like the Stockscores, abnormal activity, abnormal volume. Those are built into the tool, and those are things that you can't get other places. That's my secret sauce, and it's, I think, what allows me to find these stocks before most people. What's nice about the tool is that it will save you a lot of time and really allow you to focus in on that short group of stocks that have the best potential to beat the market. Now, in order to use the tool, you really have to know what to look for. And so a big part of what's on stockscores.com is also our education center, where I have recorded videos and written lessons and created tests and assignments so that you can work through, 12 to 15 hours of lessons. You don't have to do them all necessarily, depends what strategies you're doing, that sort of thing. But there's a considerable resource there to learn how to do this. And so it's the information on how to know when to buy, how to know when to sell, the process for finding things, how to manage risk, how to overcome your emotions, specific rules for when to buy and when to sell, which is what's in the investor and active trader sections. So there's a lot of great information on the website. So let's jump into Stockscores now. Now I have to log in because in order to get into the education center, you have to be a member. And once I'm in, I can go to the trader training section, go down to education center, and there you will see that there are 4 areas. There's the getting started, which is actually free. You don't have to pay for any of this stuff. So if you want to learn the basics, how the Stockscores indicators work, making first trades, the basics of charting, there's some videos there that I've done for that. If you want to learn about how to read chart patterns, then you get into the foundation. So the 6 elements of chart patterns, we talked about that a little bit tonight. What are predictive patterns? What's a price channel? Exit signals? You can see all the topics there. If you want to learn a little bit about options, there's some information there, but options aren't my specialty. I generally don't trade options myself. I don't recommend it for most people. If you understand options well, then I think you can do that. But most people that trade options lose money because they don't understand the added pricing component in options. They think it's all about the stock, and it's not always just about the stock. There's something here called scaling, which is how you know when to add to a position that's winning, where to put stops, the process that I use to reverse engineer the stock market and develop a trading strategy, which I still do almost daily. That's all explained in there. And for each lesson, there is a written component. So I can click on this and read that written component. There's a video. And so I can click on this. You can do this from a phone, from an iPad, from a computer. And I can just watch this 30-minute video with some nice music to it. And in that video, I explain resistance, optimism. See, there you go. Those are the 6 things I talked about tonight already. All right, if we go back to the education center and into the, oh, by the way, on the foundation section, there's also a test, an assignment. There's an assignment here. There's a little test, which is, I think this icon, no, this one, where you get a little multiple choice test. You can get the marks on it after you've completed it. And that way you can understand whether you really understood those concepts. So it's all great online learning. Now there's also my specific strategies for when to buy, when to sell, risk management. Those are explained here. These are the investor strategies, which is kind of what we're talking about tonight. And then tomorrow, we'll talk about active trader, which is day trading and swing trading. But for each of those, there's a written lesson and a video. There's no assignment or test because the idea now is you're supposed to practice in real market. That's your assignment. That's your test, to actually apply these strategies using our simulator and then ultimately using real money. All right, so that's a little tour of the education center. The market scan is what we're going to do at the end, but I have a couple more things to get to before that. But this is the market scan tool. It has all these filters which you can use to set up your own scans. Most people don't do that. It's requires a little bit of knowledge and expertise. But most people, what they do is use our preset scans. So tonight we're going to run the abnormal break scan, and we'll do that in just a moment, and we'll see if we can find some opportunities. Let's go back to the presentation. I'm going to talk a little bit about the courses that I have coming up. The market scan access is only for people that have taken one of my courses. And so there's essentially two options. There's the investor course, which focuses on longer term trading strategies, things where you're going to hold for more than a couple of weeks, but typically less than a few months. And you get access to the foundation area of the Education Center. You get access to the investor strategies. You get access to the Stockscores market scan and the preset investor strategy scans. You get email support from me as you're working your way through the material. I don't have staff answering questions from my students. I do all that myself, which is why I don't take on a lot of students. And then you get 6 months access to the market scan tool, which you can then renew for $300 per year. So it's $300 per year to use the tool. We don't make any money on that. That just pays for the data. As I said, it costs about $100,000 a year to keep this website up and running. And that $300 a year is what sort of keeps the website up. Now, the Active Trader course, which is more the topic for tomorrow's webinar, will give you everything that the investor course gives you. Again, with the Active Trader course, you get everything that is in the investor course, but you also get the Active Trader strategies. You get my proprietary indicators that you can run in real time in a program called TradeStation. For those that are able to or want to use something like TradeStation, I will give you my indicators, and I'll show you that tomorrow. We're not going to do that tonight, but tomorrow I'll show you TradeStation and how those indicators work. It makes you eligible for a service called Active Live, where you can watch my day trading analysis screen, where you can listen to my comments at the start and end of the day, where I'm teaching every single day. I'm teaching how to be a better trader. It's all done live in real time as the market is trading. I pick stocks, lots of different stuff. All right, so that's the Active Trader course. Again, we'll talk about that more tomorrow. Active Live is, again, what I was just talking about, where you're watching a live webinar, starts at market open and ends at the close of trading that day and runs every day. And it makes you eligible to subscribe to that. It's a service really for day traders. It costs $195 a month. And it's to me the best money you can spend, because you're going to get real-time analysis that will find these hot stocks before most people. So for example, BlackBerry today gave us our real-time signal at 1 o'clock, and that was at $10.51. 2 hours later, it's at $11.60. So in just the course of a little over an hour, it had moved up, more than 10%. And that's, some stocks move up much quicker than that. We just find these things right as they happen, because I've got powerful computers monitoring the entire US stock market, 7,000 stocks in real time, looking for the abnormal behavior that we'll talk about tomorrow. Okay. So twice a year, I do some live training. So in addition to all that online material that I showed you in the Education Center, you also have access to these live classes that I will do starting November 1st. So Monday, November 1st and Tuesday, November 2nd, we're going to do what's called the foundation or the overview class. That's where I teach the theory. So it's 6 o'clock p.m. Pacific time for an hour and a half those 2 nights. If you can't make those classes, they are recorded. So you can watch the video later. You can watch the video as many times as you want. There's no limit. But it is better to attend live, because you can ask questions live and I can answer them live. If you watch it as a video, I'll still answer your questions, but it's done by email. Okay. Now, in addition to that, the Wednesday, Thursday, and Friday of that week, we are going to do market scanning together to practice picking stocks. So for an hour each evening, again, starting at 6 p.m. Pacific time, we will do an hour of market scanning, looking for things. Now, I said earlier that you only have to do this 15 minutes a day, but I'm going to spend a lot more time teaching and going a lot slower than I would normally do it. And we'll do a wider range of scans as well. And then the final thing that you get when you take this course is if you take the active trader course, this is not for the investor course, but if you take the active trader course, or if you're an investor student and you upgrade to the active trader course, you will get a free month of my active live service where I am essentially, you're watching my analysis screen. The same one that I used to do my day trades, you're watching that as well. I watch the same one. Now, again, all of these classes are recorded. This presentation tonight is recorded. I will email you a link to the video, which you can watch as often as you like. And all of these classes are recorded for my students who choose to take one of these courses. Now, we have a special offer, which is good up until 11 p.m. Friday, October 29th, which is next Friday, essentially. And that is, you will get that overview class for free. You will get the market scanning for free. You will get a free month of the active live trading. And for those of you that have an interest in mentorship, so I also do a mentorship program, you will get another month of active live. So you actually get 2 months if you take the active trader course and you do the mentorship, you get 2 months of free active live. If you've already taken the active live course and you just upgrade to mentorship, then you get that 1 extra month of active live. Now, some of you might be wondering, what is mentorship? I will talk about this more on Saturday, but essentially it is a 3-month program, 14 classes, about an hour long each class, where I will walk you through the educational material as a small group. So the class is limited to 20 students, and I think we only have 5, maybe 6 spots left right now. And so for a $2,000 upgrade from the active trader course, you can do the mentorship. Let's talk about pricing now. The investor course is $2,495. The active trader course is $3,495. All prices are in Canadian dollars, by the way. The active trader includes investors, so you don't have to buy both. And the mentorship is $5,495. It includes active trader. It includes investor. Now, I know many of you maybe took my investor course last year. You want to upgrade to the active trader course. That upgrade is $1,250 Canadian. And you can do that from the Education Center on Stockscores. If you took the active trader course and you now want to do the mentorship course, that is a $2,000 upgrade. And if you want to do that, you should email me. I'll give you my email address in a moment, because there's only, I'm not sure if it's 5 or 6, but there's not many spots left for this mentorship. It always sells out, very popular, and it really is a great way to learn this. And I'll talk more about it on Saturday, assuming we have space available still. All right, so to register for the course, very simple. You go to stockscores.com, you go to the trader training area, learn how to trade, and there's a page there where there's more information on the courses, as well as where you can sign up. So right here, you click on Order Active Trader, or if you want to do the investor course, Order Investor Course. It gives you instant access. So if you were to sign up tonight, you will have access to the material, the market scan tonight, because it's all automated. You may have to log out and then back in again, because it may have to not recognize you right away, but very easy to register. And you have until 11 p.m. October 29th to register for the courses to get the live training. The sooner you register, the sooner you can start working through the material, and therefore the more you will get out of the live training that I start on November 1st. So here's a couple of comments. I'll leave this up quickly, and then we're going to do a quick poll. And the poll is basically to ask if you would like me to send you a follow-up email on the courses. I don't like to bug people. I'm not much of a pushy marketer. So if you would like to get an email from me with a little more information on the courses, then just answer this poll. So I will launch this now. And if you don't want it, say no, and I won't bug you a lot. That's not my way of doing things. So, but if you want a little bit of follow-up on the mentorship, the investor, the active trader, just let me know your preference, and we will send out an email, probably not till the weekend, but And I'll just have some links to some videos and some extra stuff to consider. So I'll leave this up for another 20 seconds or so. I always like to give people a chance to vote. Got 43% of people have voted. I don't know if that's better than the national elections. Oh, we're up to 46%. So go ahead, state your vote. You're not hurting my feelings if you say no. Don't care. My class is sellout. Doesn't matter to me. Leave it up for 5 more seconds. And if you're watching this as a video and you didn't get a chance to be on this, either attend one of the other presentations tomorrow or Saturday, or just fire me an email and just say you want a follow-up, because I know some people watch this as a video later. All right, the place to vote is right on your screen. I launched that poll. Someone's saying that they can't see it. I'm not sure why that would be, but all right, I will start answering questions soon, but I just have a couple more things to do first. So we'll close that poll down. Thanks to everyone that voted. And let's take some questions, and then we will do the market scan. So we'll do the market scan in just a moment. I'm just going to answer some of these questions first. So one question, are course costs tax deductible? You should be able, it depends on jurisdiction. So I know in Canada, you should be able to deduct the course as an interest and carrying charge against capital gains. You might want to check with your accountant on that, but that's my understanding. I know many of my students have done that. Now, some of these questions are, a little bit longer, and I got to just take a moment to read them, and I moved my mouse in the wrong spot here. Okay. How do we determine abnormal volume for different companies as companies have different floats? Well, that's the algorithm. It doesn't matter what the float size is. It matters what the volume is compared to what the stock normally trades. And so that's all built into the algorithm. It does linear regression to calculate that. And so when you run a market scan on Stockscores, which we're going to do in a moment, it will do that for you. Do you offer refresher courses for someone who has taken the investor course? Well, you can always re-watch the videos because you have access to that. So if you took the investor course 5 years ago, you still have access to all those videos online. Now, if you'd like to redo those classes at the start of the month, November 1st for that week, you can do that. It's $195 to do a retake. And I'll have a link up for that soon. So we will have that up soon. To upgrade from investor to active trader is $1,250, and you can do that from the education center. Can you upgrade from investor to mentorship? Yes, you just have to do it in 2 steps. So first you have to upgrade to active trader, and then log out of the website, log back in, and then you can purchase the mentorship. To purchase the mentorship, I'll just show you where it is because it's not in a normal spot. You have to go to upcoming events and scroll down here. And there you can see the active trader mentorship. That is where you register for that. You have to already be an active trader student to do that, but you can buy the active trader course and 2 minutes later sign up for the mentorship. You just have to log out of the website and then back in again so that the website knows that you're an active trader member. Okay, on Saturday you mentioned podcasts. Where can we find you on podcasts? I don't have podcasts. I don't know where. I was on a podcast for the Michael Campbell Show, which is a radio show that I've been on for many years. That may be what I mentioned is the Michael Campbell Money Talks show, which you can get off of the Apple podcast channel or whatever. But I don't have a podcast myself. Will becoming an active trading change the characterization of capital gains to income? Yes. If trading is your primary occupation, if you have area of expertise, there's a number of different thresholds that Revenue Canada uses to determine if you're a pro trader. So I'm a pro trader. I don't get the capital gains exemption. So I have to pay tax at the full rate. If you're investing in the market, then you get the capital gains exemption. Again, I'm speaking Canada. I don't have any knowledge of how it works in other countries, but yes, you want to be aware of that. If you're going to make trading a business, you should set up as a corporation just to get a little bit of the tax advantages. Next question. Are the mentorship classes recorded? Yes, they are. You mentioned that there is a 5-year limit to access the investor video. No, that's not what I said. I said that if you took the course 5 years ago, you can still access it. If you took the course 20 years ago, I mean, my first students were actually 20 years ago, you can still access those videos. What I'm saying is there is no limit. Is a market scan useful for dividend stocks? Yes, you can actually scan for stocks paying dividends if you like to do that. That is one of the filters in the market scanner. Day trading is not allowed in the TFSA account. That's correct. Yeah, you can't actively trade in a registered account, so you should be aware of that. I don't really like to give out too much tax advice because I'm not an accountant. I'll give you some broad strokes, but you should really look into these details yourself. Do you discuss Canadian stocks in active day session? No, our active live sessions are focused on US stocks. I will answer questions on Canadian stocks if people have them, but TradeStation, which is the platform we use, doesn't do it on Canadian markets. Now, our market scan does. The Stockscores market scan does do Canadian markets. How many times do you offer mentorship program during the year? Typically twice. Some years once. This year it's twice. T.FTT as a position trade entry here. I'm not going to do stock questions just yet. Sorry, I shouldn't have even read that out. I have many positions that yield 6% plus dividend. How should this affect decision to sell or buy more? I mean, that's a long question to answer. Really, for me, it comes down to how the chart pattern is looking and whether there is a sell signal or not. Obviously, minor sell signal, if you're collecting yield and you're looking for that income, that's a different decision. But I can't really get into all of the combinations and permutations that you might have on that. Is there a way to avoid the pump and sell stocks, pump and dump? I don't think you should avoid them, first of all. I think that pump and dump is a great way to make money. I've made so much money off of pump and dump stocks. The key is to know when to sell. And so you're not sticking around for when the dump happens. If you really want to avoid them, then I guess you try to avoid penny stocks because that tends to be where they are. But, you know, this idea that you should avoid those stocks, I think is a bad idea, because why would you want to avoid a stock that goes $1 to $3? You know, sell it. If it goes up and then starts to go down, sell it. I have no problem trading those stocks. How frequently do we need to run the tool during trading hours? Depends on what strategy you're doing. If you're an investor, you do it once a day. If you're a day trader or a swing trader, you might do it a few times a day. All right, let's run a market scan and see how we do here. So I'm in the Stockscores tools here. Go to the market scan. Excuse me. And we're going to run the Abnormal Breaks Canada scan, and primarily because it'll give us a little shorter list, and I don't want to have to go through a lot of stocks tonight, just because I know some of you maybe have other things you want to do than listen to me all night. So it found 12 stocks. So it just went through the entire Canadian stock market, and it found 12 stocks that did something abnormal today. And so then it becomes a question of, does it have the right chart pattern? So I look at this stock, and it did abnormal things. You can see the volume traded was abnormal. The price action was abnormal. The problem is it's moving up into pessimism because there are falling tops in this chart. So one of the things you're going to learn is that that is not a chart to trade. So I would pass on that. So as I go through these charts, I'm looking for the right kind of chart pattern. All right, so this one had the right chart pattern a few months ago, and I'm going to blow this up and draw on it a little bit. But you can see that this stock was trading sideways. It had rising bottoms, and then it traded with abnormal volume and abnormal price action there at around 35-40 cents. And a few days later, it's at 90 cents. So it made a nice quick pop. Today, it made another break, but in this case, it's going to get stuck at this old ceiling price. So that lowers the quality of it. I do think that this stock looks pretty good, but it's maybe a 6 out of 10 if I was to give it a numerical rating. Right? This one's not good. This one's not great. This one's too late. So you notice I'm going through these pretty quickly. With what you learn in the course material and practice, within a couple of months of doing this, you can go through these quickly as well. In your first week, you're going to go slow. It takes time to practice. But there's videos that show you how to do this. And it's really always just looking for 6 different things and how they work. Now, remember I said BlackBerry gave a good day trade signal today. So on the longer term chart, as a position trade, it's not great. It's got resistance here that's going to slow it down, resistance there. Doesn't really have any optimism yet. There's no rising bottoms. So as a position trade, it is not good today. But I'm going to show you the intraday chart to show you why it was good as a day trade. So here it is as a day trade. Remember I said 1 o'clock? Look what happened at 1 o'clock. Big spike of volume, big price spike from boring sideways trading. So that's where we had that buy signal. This is the Canadian listing. I had given you prices earlier on the US listing, which the entry signal on the US listing was at 10.50. On the Canadian listing, because of the Canadian exchange, it's $13 and it went to $14.20, right, in the course of 2 hours. Okay, so sometimes the stock is worth trading on one time frame, but not on another one. And so that's important to understand. You know, I always ask people for context. Some people will say, well, what do you think of BlackBerry? And I would say, well, as a day trade, swing trade, position trade, as something you bought, something you want to buy, like we always need to understand context because the answer changes. Let's go to the next page. So this is one chart that I think is pretty good for a longer term trade. This is Finning, and you'll see here that it broke through a ceiling price today. So it's been trading under $35 for many months, and today it broke through that. Now, there's a bit of a problem. There's a couple of problems. One, the volume wasn't all that strong. It's stronger than normal, but not exceptional. Second problem is that it's been going up for a couple of weeks already, and that increases the chance that it will pull back before it goes higher. So I like it longer term, and what I mean by that is when I look at the 3-year chart, I like that pattern on the 3-year chart. This is the 3-year weekly chart, and it's making a good breakout. So looking out months, maybe even like 6 to 8 weeks, I think the stock will do well. Looking out the next week, it wouldn't surprise me at all if it pulls back a little bit. So if you're looking for that longer term holding in your retirement portfolio, I think this stock looks pretty good. Pays a 2.6% yield, which is not crazy, but it's not bad. And it's got a decent pattern where I think, you know, in the months ahead, it probably moves higher. All right, so that's the tool. And, pretty simple to use. That first week in November for all of the students who take either the investor course or the active trader course, we're going to do this for an hour. We're going to do lots of different scans. I'm going to get you to practice seeing these patterns and teaching you what to look for. And, we go through 20 charts to find one good one. We went through 12 tonight to find one good one. That's sort of the ratio we're looking for. All right. Someone asking what time frame you are running this tool. It runs on the daily time frame. Any advice on how to pick a broker? Well, it's not all about cost. And it really depends on what kind of a trader you want to be. If you are an active trader, then you want a broker that gives you direct access to the markets and you're not going through a market maker. If you're an investor, going with your bank broker is probably fine. But if you're an active trader, then going through brokers that really have the tools for active traders is more important. And again, every country has different ones. Here in Canada, Interactive Brokers, TD, and what's the other one? Quest. Those are kind of the popular 3 for active traders. For investors, the big bank brokerages, Interactive Brokers, they're all pretty good. But I can't give one answer for everyone because it depends a lot. Is your method more beneficial for day trading rather than investor trading? No, it works the same. Conceptually, it's the same. Day trading is faster and it takes more time, takes more attention. I would say it takes more emotional control, but the method works well for all time frames. All right, so I think we're pretty much ready to wrap it up. There's my contact information. If you have any questions, you can email me. You can follow me on Twitter. Most important thing is subscribe to my YouTube channel. I put up at least one video every week. You're getting free education every week on YouTube. So go to YouTube, search for Stockscores, and subscribe to the channel. And you'll get some good free stuff every week, every Sunday usually. I do that. All right, and someone has just informed me that they have signed up for mentorship. So if it was 6, now it's 5. It was 5, now it's 4. I can't remember. I have to look at my numbers. But anyway, like I said, that sells out. And if you want to do the mentorship, probably a good idea to send me an email and ask me questions. Again, don't worry about me giving you pushy sales pitches. I don't do that. I want people to take this because it's right for them. And if you think it's right for you, then sign up. If not, maybe we'll see you another time. I'm going to wrap it up there. I want to thank you all for joining me tonight. Hopefully it was informative. Tomorrow's presentation is focused more on day trading and swing trading. And we'll go into a little bit more of the cool tools that I've developed. So hopefully many of you will join me for that as well. And then Saturday, we're going to do a session on more detail about the courses, the investor course, the mentorship course, the or the active trader course. It'll all be covered in more detail on Saturday. Thanks, everyone. Hope you've enjoyed it. Trade well.